Imagine two 25-year-olds. They have the same salary, the same savings, the same financial habits, and they both receive the same unexpected windfall of $60,000. One of them uses that money as a down payment on a small starter home in a mid-sized city. The other opens a brokerage account and puts the entire amount into a low-cost globally diversified index fund. Neither choice is obviously wrong. Both have been recommended by countless financial experts, parents, and successful friends. And yet, if you follow these two people for the next 30 years, their lives look remarkably different, not just in their net worth but in their career choices, their stress levels, their geographic mobility, their relationship timelines, and even their physical health. The difference between buying a house in your 20s and investing the same money is not merely a mathematical difference in expected returns. It is a difference in the structure of your life, the constraints you accept, and the optionality you preserve. To understand this comparison clearly, we have to first define the baseline assumptions, because the math only matters if the inputs are realistic. The median first-time home buyer in the United States is now 36 years old, not 25, which tells you something about how difficult it has become to buy in your 20s. But for those who do, the typical down payment ranges from 5 to 20% of the purchase price. Let us assume our 25-year-old buyer puts 10% down on a $300,000 home, which means a $30,000 down payment, leaving the other $30,000 of their windfall for closing costs, immediate repairs, and a small emergency fund. The mortgage on the remaining $270,000 at a 7% interest rate over 30 years gives a monthly principal and interest payment of approximately $1,796. Add property taxes, homeowners insurance, and maintenance, and the total monthly housing cost lands somewhere around $2,400. Now consider the investor. The same $60,000 goes entirely into a diversified portfolio of global stocks, held in a tax-advantaged account if possible, or a standard brokerage account if not. Historical long-term real returns on a balanced global portfolio after inflation have averaged between 4 and 7% depending on the time period you examine. For our calculation, we will use a conservative 5% real return, meaning after adjusting for inflation, because inflation affects both scenarios similarly but showing nominal numbers can be misleading over 3 decades. $60,000 growing at 5% per year for 30 years becomes approximately $259,000 in today's purchasing power. That is a substantial number, but it is not the full story, because the home buyer is also building equity and benefiting from appreciation. The home buyer's $300,000 home, if it appreciates at 3% per year above inflation, a fairly typical long-term average for U.S. housing, would be worth approximately $728,000 in today's dollars after 30 years. However, the home buyer has also paid significant interest over that period. Over the life of a 30-year mortgage at 7%, total interest paid is roughly $377,000. Add property taxes, insurance, and maintenance, and the total cost of ownership far exceeds the purchase price. After 30 years, the home buyer owns an asset worth $728,000, but they have paid well over $500,000 in non-recoverable costs to get there. The investor, by contrast, paid very little in ongoing costs, just the expense ratio of the index fund, typically less than 0.1% per year, and has $259,000 in liquid assets that can be accessed at any time without selling a roof. The raw numbers suggest that the home buyer ends with a larger nominal net worth, but that conclusion depends entirely on whether you count the home as an asset you can spend. A primary residence is not a liquid asset. You cannot sell your kitchen to pay a medical bill or borrow against your bathroom to start a business without incurring significant transaction costs and interest. The investor's $259,000 is cash, or at least cash equivalent after a few days of settlement. That liquidity changes what is possible in your life. The investor can take a career break, start a company, pay for graduate school, or relocate to a different city for a better job without selling their home first. The home buyer, even with higher net worth on paper, has almost all of their wealth trapped in a single illiquid asset that is expensive to sell and whose value is tied to a single local housing market. This leads to the first major life difference: career flexibility. The person who rents and invests in their 20s can move for a job opportunity in a different state with 30 days' notice and a moving truck. The person who buys a home cannot. Selling a home takes months, costs 6 to 10% of the sale price in commissions and fees, and is emotionally exhausting. If the housing market has dipped since purchase, selling might mean bringing cash to closing just to get out from under the mortgage. Many homeowners in their 20s and early 30s report turning down job offers that would require relocation because the math of selling their home does not work. They are geographically locked. That lock-in effect is not just a minor inconvenience, it is a measurable drag on lifetime earnings. Studies show that homeowners are less likely to move for higher wages, and that this reduced mobility costs them between 5 and 15% of potential lifetime income growth. The second major difference is risk concentration. The home buyer in their 20s is making the largest financial decision of their life so far, and they are putting all of that money into a single asset in a single neighborhood in a single city. If that local economy struggles, if a major employer leaves town, if crime rises, or if the housing market simply stagnates for a decade, the home buyer has no diversification. Their entire wealth is tied to one address. The investor, by contrast, owns a tiny sliver of thousands of companies across dozens of countries. If one sector fails, if one country has a recession, the rest of the portfolio continues growing. That diversification does not guarantee higher returns, but it dramatically reduces the risk of a catastrophic loss. A homeowner in Detroit in 2005 or in Las Vegas in 2008 learned this lesson painfully. An index fund investor in the same years saw their portfolio drop, but they did not lose everything, and they did not find themselves underwater on a mortgage worth more than the home securing it. The third difference is the psychological weight of debt. A 25-year-old with a 30-year mortgage has committed to a monthly payment that will not change significantly for 3 decades, though taxes and insurance will rise. That fixed obligation shapes every other financial decision. A job loss becomes a crisis rather than an inconvenience. A pay cut becomes a threat to shelter. The investor with no mortgage but a rental payment has a much smaller fixed obligation. If they lose their job, they can move to a cheaper apartment, get a roommate, or even move back in with family temporarily. The homeowner cannot easily reduce their housing cost without selling or defaulting. This difference in fixed obligations changes risk tolerance, which changes career choices. People with high fixed costs are less likely to start a business, take a lower-paying but more fulfilling job, or negotiate aggressively for a raise because they cannot afford a period of unemployment. The investor with liquid savings and no mortgage has the freedom to take calculated risks that often lead to higher lifetime earnings. There is, however, a strong counterargument that must be taken seriously. Homeownership provides forced savings for people who would otherwise spend their excess cash. The monthly mortgage payment is a form of automatic wealth building, whether the owner thinks about it that way or not. Many people who say they would invest the difference instead of buying a home do not actually invest the difference. They spend it. The home buyer ends up with $700,000 in home equity after 30 years because they had no choice. The would-be investor often ends up with nothing because they never set up the automatic transfers, or they raided the brokerage account for a vacation, or they lost confidence during a market downturn and sold at the wrong time. The behavioral advantage of homeownership is real and significant. A mortgage forces discipline in a way that a voluntary investment plan does not. The other genuine advantage of buying in your 20s is leverage. When you buy a home with 10% down, you are controlling a $300,000 asset with only $30,000 of your own money. If the home appreciates 3% in a year, that is $9,000 of gain on your $30,000 investment, a 30% return on your down payment, minus interest and costs. The investor with $60,000 earning 5% makes $3,000 in the same year, 1/3 as much in absolute terms, even though they invested twice as much capital. Leverage magnifies gains when prices rise. It also magnifies losses when prices fall. In a declining market, the homeowner can lose more than their entire down payment if they need to sell. But over 30 years, housing prices in most major markets have risen enough that leveraged ownership has produced strong returns for people who held on through the downturns. The comparison also depends heavily on what happens to the monthly cash flow difference between owning and renting. In many markets today, the monthly cost of owning, including mortgage, taxes, insurance, and maintenance, is significantly higher than renting an equivalent property. That difference is often $1,000 per month or more. If the renter invests that $1,000 per month in addition to their initial $60,000, the gap between the two scenarios widens dramatically. An extra $1,000 per month invested for 30 years at 5% real return adds approximately $830,000 in today's purchasing power. In that scenario, the renter-investor ends with over $1 million in liquid assets, far exceeding the homeowner's home equity. If, however, owning is cheaper than renting in a particular market, or if the homeowner rents out a room to cover part of the mortgage, the math shifts back toward ownership. There is also an emotional and psychological dimension that numbers cannot capture. Homeowners report higher life satisfaction in some studies, though the effect is small and tends to fade after the first few years of ownership. There is a genuine sense of stability and belonging that comes from owning your own home, from being able to paint the walls any color you want, from knowing you will not receive a non-renewal notice from a landlord. For many people, that feeling is worth a significant financial sacrifice. The question is whether that feeling is worth the trade-offs in flexibility, liquidity, and risk concentration, especially when you are in your 20s and your life is likely to change in ways you cannot predict. The person who buys a home at 25 and marries at 28 might find that the home is too small for their growing family. The person who stays single might find that the home is too large and too isolated. The person who gets a dream job offer across the country faces the selling dilemma. The historical parallel here is instructive. In the decades following World War II, buying a home in your 20s was an unambiguous financial win for most Americans. Housing prices rose steadily, interest rates fell from the high teens of the early 1980s to near zero in the 2010s, and the tax code heavily favored ownership through the mortgage interest deduction. That era created a cultural assumption that buying a home is always the right move, the adult move, the wealth-building move. But the economic conditions of that era are not the economic conditions of today. Interest rates have normalized, housing prices in many cities have risen far faster than incomes, and the tax benefits of ownership have been reduced. The cultural script remains, but the math has changed. What worked for your parents or your grandparents might not work for you, not because you are different, but because the world is different. The investor path has its own psychological challenges. Renting in your 20s and 30s while watching friends buy homes can feel like falling behind, even when the math says you are not. There is social pressure, family pressure, and internal pressure to achieve the markers of adult success, and homeownership remains one of the strongest markers. The renter-investor must have the discipline to ignore that pressure, to automate their investments, and to accept that their wealth is invisible, stored in a brokerage account that no one sees or celebrates. The homeowner gets a key, a door, a neighborhood. The investor gets a quarterly statement. One feels real. The other feels abstract. Behavioral finance tells us that humans consistently overweight concrete present benefits and underweight abstract future benefits. That bias is exactly why many people should buy the home, because they will not stick with the investment plan otherwise. So which path is right for a person in their 20s? The honest answer is that it depends on the person, the city, the housing market, the interest rate environment, the person's career trajectory, their relationship plans, their tolerance for risk, and their ability to automate savings without a mortgage forcing them. The mathematical answer is that in most high-cost coastal cities today, renting and investing the difference produces higher long-term wealth for disciplined investors who actually invest the difference. The mathematical answer in many Midwestern and Southern cities, where home prices are lower relative to rents, tilts toward ownership. The behavioral answer is that most people should buy only if they are certain they will stay in the same city for at least 7 to 10 years, only if the monthly cost of owning is not significantly higher than renting, and only if they have a separate emergency fund beyond the down payment. The deeper lesson is not about houses versus stocks. The deeper lesson is about understanding what each choice does to the structure of your life. Buying a home in your 20s locks in your location, your monthly costs, and a significant portion of your wealth into a single asset. That lock-in can be bad if you value optionality, if you are early in a career that might require relocation, if you are unsure about where you want to live long-term. Investing the same money preserves optionality, liquidity, and diversification, but requires the discipline to actually invest and not spend, and the emotional resilience to tolerate the social pressure of renting while others buy. The calm closing thought is this. The choice between buying a home and investing the money in your 20s is not a choice between right and wrong. It is a choice between different kinds of lives. The homeowner's life is more fixed, more rooted, more constrained in some ways but also more stable and more psychologically rewarding for many people. The investor's life is more flexible, more liquid, more uncertain in some ways but also more adaptable to unexpected opportunities. Neither path guarantees wealth. Neither path guarantees happiness. The only guaranteed mistake is making the choice without understanding the trade-offs, without running your own numbers for your own city and your own income, and without honestly assessing your own discipline and your own values. The house will still be there in your 30s if you change your mind. The investment account will still be there in your 40s. The 20s are for learning, not for locking in permanent answers.